The Strait of Hormuz just made headlines, and the market yawned. You are looking at Brent crude sitting at 104.22, and I know exactly what you are thinking right now. I am Eric from Alpha Market Meridian. You are thinking, with all the geopolitical tension, with supply routes threatened, why is this market not exploding through 106.50? And that question, that exact question, is the trap that is about to separate the losing traders from the profitable ones today. There is one danger zone in this Brent price action, and there is one hidden opportunity that the herd is completely blind to. I am going to show you both before the London session makes its decision. Stay until the end because I am giving you 3 exact entry and exit levels you can deploy right now, with precise stop losses and risk-reward ratios that a professional trader would respect. Here is your instant market verdict for Brent crude on this session. The bias is trend continuation with a fading component. The daily chart is unambiguously bullish. The 5-hour chart is unambiguously bullish. But we are pinned below a resistance zone that has rejected price multiple times, and the news catalyst that was supposed to ignite the breakout has failed to do so. That is a dangerous combination. It means we are either consolidating for a massive expansion higher, or the failure to rally on good news is a silent distribution signal. My lean today is bullish continuation, but only if one specific condition is met. Write this number down right now. If Brent breaks and closes below 103.04 on the 4-hour timeframe, the entire bullish structure shifts to neutral, and we are likely to see a liquidation cascade down toward the 100-day moving average. One invalid level. 103.04. That is the line in the sand. If you are watching this and you have a position, put that number on your screen, put it on a sticky note, put it in your trading journal. That is what separates a plan from hope. Now let us walk through the technical landscape from the top down, because the monthly and weekly charts are setting context that the 60-minute traders are completely ignoring, and that is where the money is hiding today. On the daily time frame, Brent crude is painting a textbook structure. We have had a sustained rally off the lows, and price is now consolidating in a tight band directly above the 20-day moving average. I want you to visualize this because I am not going to show you a chart with a laser pointer and a bunch of arrows. I am going to speak the chart into your mind. The 20-day moving average is acting as dynamic support right now, sitting in and around the 103.43 area. That is no coincidence. That number, 103.43, is your first key support. It is a fusion point where a moving average and a prior swing low align. When you get that kind of confluence, institutional algos are programmed to react there. The 60-day moving average is sloping upward below that, giving the trend a structural flaw. And the 200-day moving average, it is far below, acting as the long-term anchor, not relevant for today's tactical trading but screaming that the macro trend is intact. Now look at the MACD on the daily chart. We have a bullish histogram, but pay attention to the signal line divergence. The momentum is positive but decelerating. That is not a sell signal. That is a pause signal. It means the market is recharging. Think of it like a sprinter taking a breath before the next 100-meter dash. That breath can turn into a collapse if the lungs fail, but right now, the physiology of this chart says reaccumulation, not distribution. Drop down to the 4-hour time frame, and this is where the chess match really begins. The 4-hour chart shows a series of higher lows, each one respected. The last higher low was carved out right at the 103.04 zone. That is your second key support, and it is more important than the first for intraday structure. If 103.43 is your early warning signal, 103.04 is your invalidation trigger. On the 4-hour MACD, we are seeing something critical that most retail traders will completely misinterpret. The histogram is flattening near the zero line, and the signal lines are coiling. This is a compression pattern. Compression precedes expansion. The longer Brent stays in this 103.04 to 105.73 range, the more violent the eventual breakout will be. I am not talking about a 50-cent move. I am talking about the type of move that fills your stop and then runs 200 cents without you. That is the Setup we are sitting in right now. On the 60-minute chart, the noise is high. The 20-period moving average on the hourly is oscillating around the 104.00 handle, and price is whipsawing around it. This is a scalping trap. If you are trading the 60-minute chart in isolation today, you are going to get chewed up. The false breakouts on the hourly timeframe are designed to trigger stop losses above 105.00 and below 103.50 before the real move begins. How do I know this? Because the higher timeframe structures have not broken. The fake out on the low timeframe is the entry signal on the high timeframe for smart money. Do not fall for it. Now let us talk about resistance. 105.73 is the immediate wall. That level is derived from a prior swing high that has been tested 3 times in the last 2 weeks. Each test has been rejected, but the tests are getting closer together and shallower. That is a breakout precursor. Above 105.73, you have 106.49, which is the structural high that, if broken, opens a straight path to the next leg higher with no technical friction. The daily support and resistance levels are so clean today that even a novice can see them, but only a professional knows how to trade them. The amateur sees 105.73 and sells it. The professional waits for the break and buys the retest. That is the game. Here is where the cross-asset narrative gets fascinating, and this is where you stop being a single asset trader and start thinking like an institutional macro desk. Oil and gold are both inflation and geopolitical barometers, but they are singing slightly different songs right now. Gold has been bid, finding that geopolitical fear bid. But that bid has not translated into Brent because the market is processing the headline through a temporal lens. The Strait of Hormuz closure was brief. Logistics were disrupted, but the barrels kept flowing. The geopolitical premium that spiked into the event is now being priced out. That is the cross-check. If gold starts selling off aggressively while oil holds these levels, that tells you the inflation narrative is taking over from the pure fear narrative. That is a bullish regime switch for Brent. If gold spikes again and oil fails to follow, that means the market is pricing a demand destruction scare. Either way, the correlation is giving you a signal. Watch the gold chart alongside your Brent chart today. If you see divergence, act on it now. The news. Goldman Sachs just published a note listing 3 reasons why the strait closure caused only moderate economic damage. Reason 1. The duration was limited. The market has learned that these events spike and then resolve, and the memory is short. Reason 2. Alternative routes and strategic reserves were activated. The buffer system worked. Reason 3. Demand forecasts are already softening from the Chinese reopening that has underwhelmed relative to expectations. That third reason is the sleeper headline that no one is talking about. The Chinese demand proxy, and by extension the Australian dollar, which is the China proxy, has been putting in a risk barometer signal that is not confirming Brent's bullish structure. If you are watching my Australian dollar to US dollar video, you saw me flag this. The currency of the commodity exporter is diverging from the commodity price. That is a yellow flag. It does not mean sell Brent. It means be more cautious on the long side than you want to be. 1 to 2 week directional lean. I am cautiously bullish. The reasons. The trend structure is intact. The moving averages are stacked bullishly. The supply side of oil, outside of the Strait headlines, is structurally tight. OPEC is maintaining discipline. U.S. strategic reserve is depleted and will need to be refilled, creating a structural bid floor. But the demand side is a question mark, and that question mark is what caps the upside until we get a decisive break. The exact event that invalidates this bullish lean. A daily close below 100.00, the psychological and moving average cluster. Or a break of correlation where both gold and the Australian dollar collapse together while oil holds up. That would signal a forced liquidation event in commodities. Watch those correlations. Most people will skip this next section because they think the analysis is enough. It is not. This is where money is made. This is where I give you the exact blueprint. Keep watching, because I am about to hand you the trigger points, the stop losses, and the targets that turn this. Analysis into a P and L number on your account statement, Strategy 1. This is the sniper. This is the conservative trade approach for Brent today. The trigger condition. We want to see a 4-hour candle close above 105.73, and then we want a retest of that level as support on the 60-minute time frame. That retest must show a bullish rejection wick or a strong bullish engulfing candle at the level. No chasing the breakout. If you chase, you become the liquidity. The sniper waits for the confirmation. Entry is at the retest of 105.73 after the breakout, with a limit order at 105.80 to 105.90 to allow for the spread and the wick. Stop loss is at 105.10, which is just below the intraday swing low that should form during the retest. That is a 70 to 80 cent stop. Your first target is 106.49, the prior structural high. That gives you a risk-reward ratio of roughly 1 to 1 on just the first target, but the sniper does not take full profit at target 1 because the break of structure implies continuation. So take 50% off at 106.49, move your stop to break even, and let the rest run to target 2, which is 107.80. That extends the reward to risk out past 1 to 3. What voids this setup? If the breakout above 105.73 happens on low volume, on a Sunday open, or it wicks above and immediately closes back below, you abort. Do not marry the idea. Marry the execution. If the 4-hour candle closes back below 105.73 within 2 candles of the breakout is false. You exit the retest immediately or do not enter. This is the highest probability setup on the board today, Strategy 2. This is the active trader. This is for someone who wants to engage the range before the breakout and use the moving average confluence for a higher reward to risk entry with a wider stop. The entry condition is a clean pullback to the 103.43 to 103.04 support zone on the 60-minute chart. We need to see price approach that zone and show a bullish reversal signal. The ideal catalyst is a 60-minute bullish pin bar or a Morningstar pattern directly on top of that zone with the 20-day moving average underpinning it. The aggregate entry is between 103.50 and 103.15 depending on the wick depth. The stop loss goes below the zone at 102.85. That is a 30 to 65 cent stop depending on your entry, which is manageable. This is a mean reversion trade. You are buying the dip in a bull trend. That is the bread and butter of institutional trading. Your first target is the mid-range resistance at 104.80. Your second target is the range high at 105.73. Once target 1 is hit, you move your stop loss to break even immediately. Do not hesitate. The active trader protects capital first and asks questions later. Once target 1 is secured and stop is at break-even, you have a free trade running to target 2. The risk-reward starts at roughly 1 to 2 and expands to 1 to 3 or more if the breakout materializes. If the zone breaks below 102.85 and a 4-hour candle closes beneath it, this trade is dead and you take the loss without argument. Now here is the interaction cliff before I give you the high-risk aggressor setup. I want to see how aligned this community is. Type your Brent trading range for tomorrow in the comments right now. Give me a high and give me a low. I am reading every single one of them. The best analysis often comes from the collective intelligence in this comment section, and I want to see if you are seeing patterns that I need to incorporate into tomorrow's briefing. Do not just watch. Participate. Drop your range, and tomorrow I will call out the closest calls, Strategy 3. This is the aggressor. This is not for most of you. This is a countertrend, momentum fade entry on smaller timeframe extremes, and it carries elevated risk. The trigger here is a failed break of 105.73 on the 15-minute chart. We want to see Brent spike up to 105.73, maybe even pierce it by 10 or 15 cents, and then violently reject with a 15-minute bearish engulfing close back below 105.30. That is a trap. The breakout traders just got trapped, and you are going to short their stops. Entry is aggressive at the close of that 15-minute engulfing candle, around 105.20 to 105.00. Stop loss is tight, above the spike high at 105.85. Your stop is 65 to 85 cents. Your first target is the 20-day moving average support at 103.50. Your second target is the 103.04 invalidation level. This is a counter-trend scalp designed to capture the rejection of a false breakout. It is high risk because you are fighting the daily and 5-hour trend. The only reason this setup exists is because we have a multi-tested resistance level that could generate one more rejection before the real break. If you do not know how to lose small and manage risk aggressively, skip this setup entirely. I am putting this here because I said I would give 3 strategies, not because I want you to take it. The sniper and the active trader setups have a much higher probability of success. The aggressor is for people who understand that sometimes the best trade is the one you take knowing it has a 30% hit rate and a 3-to-1 payout, and you size accordingly with 1% of capital. Let us talk risk management. 30 seconds, but it is the most important 30 seconds of this entire video. Never risk more than 1 to 2% of your account per trade. No positions through high-impact news events like the US crude oil inventories data. Stops are non-negotiable. If you get stopped out, the market owes you nothing. Live to trade another day. The traders who blow up are the ones who move their stops lower or wider to avoid being wrong. The traders who get rich are the ones who let their stops get hit and then calmly evaluate the next setup. Be the second trader. Here is your close and your retention loop. The most critical level for the next session is 103.04. If that level holds, the bullish structure is alive and the breakout above 105.73 is a matter of when, not if. If that level breaks, the entire thesis shifts, and you need to be ready to pivot to selling rallies, not buying dips. Tomorrow, I am going to focus on the crude oil inventories data cross-referenced with the US dollar index reaction and the S&P 500 risk appetite signal. That confluence will tell us if this Brent breakout has the macro backing it needs to sustain. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live right now. Check the end screen. The correlation between risk assets is fracturing, and if you are trading Bitcoin without understanding what the S&P is doing, you are trading with one eye closed. Go watch that video next. It will connect all the dots from the Brent narrative to the risk asset complex. Smash the like button if this analysis gave you a clear plan for your session. Subscribe and hit the bell if you want daily coverage on all 8 key assets with real institutional trade setups, not just chart drawing and hopium. This channel is built for traders who want a professional edge every single day. The work is done. The levels are set. Now it is on you to execute with discipline. I will see you in the next one.